The stock market is a powerful tool for building wealth. It has made fortunes for patient people over many decades, yet for so many others, it becomes a place of frustration and loss. The confusing part is that these losses often have little to do with the market itself. They are not usually caused by corporate scandals, economic collapses. The biggest enemy to our investment returns is often the person we see in the mirror every morning. We are wired with certain ways of thinking, certain emotional responses. These instincts served our ancestors well but work against us when it comes to managing money. These mental glitches are not signs of low intelligence. They affect everyone, from novice investor to seasoned professional. The difference is that successful investors learn to recognize these traps. They understand that their own instincts can be their worst guide. They build systems and habits to protect themselves from themselves. This essay is about identifying those common mental traps. It is about understanding why we make the choices we do, and how those choices can quietly destroy our financial progress. The goal is simple: to help you keep more of the money you earn and invest. The problem is that money is not just numbers on a screen. Money is deeply emotional. It is tied to our sense of security, our hopes for the future, our social standing. When we see our portfolio value drop, it does not feel like a statistical fluctuation, it feels like a direct threat. This emotional weight makes it incredibly difficult to act rationally. We feel an urgent need to do something to stop the pain. Unfortunately, the thing we often do in a hurry is the exact wrong thing, turning a temporary paper loss into a permanent, real one. Understanding these patterns is the first step toward overcoming them. You do not need a degree in finance, a complex algorithm to succeed. One of the most powerful forces in investing has a simple name: loss aversion. Psychologists have shown the pain of losing $100 is roughly twice as intense as the pleasure of gaining $100. Our brains are wired to be sensitive to threats and losses. In the ancient world, losing your food supply was a much bigger deal than finding an extra berry bush. That survival instinct becomes a liability when financial assets fluctuate every single day. This fear of loss drives one behavior: panic selling. Imagine you own a stock and it drops 20%. The headlines are screaming about a market downturn. Your account balance is flashing red. The emotional part of your brain screams, "Get out! Stop the bleeding before it gets worse!" So you sell. The immediate feeling is one of relief. The pain has stopped. But you just turned a temporary, on-paper setback into a permanent, irreversible loss of capital. You locked in your losses at the worst possible time. Markets tend to recover over the long run. Selling in a panic removes your chance to participate in that recovery. Someone who sells their entire portfolio in a crash locks in losses, and then wonders when to get back in. Most panic sellers wait until the market has already recovered. They end up selling low and buying high. This mistake devastates long-term returns. The fix is not to become a robot devoid of emotion. That is impossible. The fix is to create a rule-based system before the panic sets in. Rule: I will not sell based on market news alone. Rule: I will only sell if the fundamental reason I bought has changed for the worse. Humans are social creatures. We find safety and validation in numbers. When we see a large group doing something, our instinct is to assume they know something we do not. We follow the crowd. This is called herd behavior, and it fuels manias and crashes in financial history. When a stock is soaring or an entire market is soaring, your neighbor talks about profits, your taxi driver talks about profits. FOMO becomes overwhelming. People pile in, often without studying the investment, simply because everyone else is doing it. Prices get pushed far beyond underlying value. Logic is tossed aside, replaced by momentum and speculation. This is how bubbles are born. Crowds drove prices to unsustainable heights. But crowds are fickle. Momentum can flip and send prices crashing fast. The solution: commit to independent thinking, not contrarianism for its own sake. Have your own reasons for buying an investment, independent of the crowd. Before you buy, write 1 or 2 simple sentences explaining why. For example, I am buying this company because its earnings are growing consistently, and it has a strong competitive advantage. This forces decisions based on facts, not popular opinion. When the crowd runs, recheck your original reason. Has it changed? That creates an anchor of logic in a sea of emotion. Next, we tackle overconfidence. Why thinking you are smarter can make you poorer. Confidence is generally a good thing, but in investing, overconfidence can be financial poison. Many people believe they can outsmart the market, a great doctor, a brilliant lawyer. They can also be a master stock picker. Overconfidence often leads to excessive trading. They jump in and out of stocks, trying to time the market's every move. Very few people can successfully and consistently time the market. Every time you trade, you incur costs, brokerage fees, the bid-ask spread, and often higher taxes on short-term gains. These costs act like a constant drag on your performance. Overconfidence causes concentrated, high-risk bets. This can occasionally lead to a massive windfall, but more often leads to a devastating loss. The future is unknowable. Even promising companies can fail. Concentrating in one or two ideas is gambling, not investing. Build your core around low-cost index funds or ETFs. Admit you cannot predict tomorrow, next week, or next year. A very common and tempting trap for investors is to look at what has performed best recently and pour all their money into it. This is called chasing performance, or recency bias. If a fund returned 50% last year, it feels like the smartest place to put your money. But markets are cyclical. Star performers often lag next year. Piling in means buying near the peak, before reversion to the mean. You become exit liquidity for early investors taking profits. This is why average investor returns trail the funds they buy, buying high, selling low. A powerful solution: dollar cost averaging combined with a long-term asset allocation. Decide on a mix, say 60% stocks and 40% bonds. Invest a fixed amount on a regular schedule regardless of headlines. You buy more when prices are low and fewer when high, removing emotion and ending hot trend chasing. Our brains love shortcuts. Two of the most common shortcuts that get investors into deep trouble are anchoring, confirmation bias. Anchoring is our tendency to fixate on the first information and use it as a reference for future decisions. In investing, that is usually the price we paid. If you bought at 100 and it drops to 50, you get anchored to 100. You might say, I will sell when I get back to even. The price you paid is irrelevant to future prospects. What matters is value, today, and future earning power. Anchoring can keep you in a failing business for years, or stop you buying a great company now fairly priced. Investor, too expensive. Confirmation bias is anchoring's cousin. We seek confirming news and dismiss disconfirming facts. Fight it by actively finding the bear case and doing a pre-mortem. What facts would prove me wrong? Some of the biggest losses are not dramatic overnight shocks. They are slow, silent, steady losses over years. High fees are the prime culprit. 1% per year sounds small but devastates compounding. Over 30 years, a 1% fee can consume nearly a third of your wealth. Costs hide in documents. You do not see money leave, only lower returns. Frequent trading racks up commissions and higher short-term taxes. Despite marketing, most high-cost active funds underperform low-cost index funds over time. Costs are controllable and predict future returns. Become a relentless cost cutter. Favor low-cost index funds and ETFs. Expense ratios of 0.10% or less beat 1.0% by miles. Adopt buy and hold to minimize trading costs and maximize tax advantages. Minimizing fees and taxes gives you a massive permanent edge without extra risk. Many people wander into the stock market with no real plan. They have a vague goal, but no definition of how or what it means. They have not defined time horizon, risk tolerance, or responses to downturns. Without a plan, you are adrift in a sea of noise, headlines, and expert opinions. Investing without a plan is entertainment, an expensive one. A plan can be a simple one-pager outlining goals and rules. What is this money for? What is the time horizon? How much risk can I stomach? Define an asset allocation that fits your horizon and sleep at night factor. Your allocation is your North Star and drives long-term outcomes. Codify contributions and responses to volatility. Invest X monthly. Do not sell in crashes. Schedule a yearly rebalance to targets. Writing rules turns intentions into commitments. Your written plan is your shield and anchor when storms arrive. We have covered a lot of ground, identifying the mental traps that cause people to lose money. Avoiding these traps does not require genius, it requires discipline and a simple process. Turn investing from a casino into a systematic, boring process. Boring is where wealth is built. Make fewer decisions. Focus on savings rate, costs, asset allocation, and behavior. Humility and patience win. It is a marathon that begins with one deliberate step. 1. Write down your goal. Take 5 minutes. Write, I am investing for goal over the next number years. Post it where you see it. 2. Check your fees. If your largest holding costs over 0.50%, find a lower cost index alternative. 3. Automate one thing. Set a $50 transfer to your investment account for next month. 4. Schedule a do-nothing day. Wait 24 hours before trading on headlines. This is not a plan to get rich quick. It is a plan to avoid getting poor slowly. Let compounding work for you, not against you.